Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 330 of the Independent Advisors Podcast. On today's show, we're going to cover a few timely and important topics, including how the top market days drive a lot of performance for a given calendar year, S&P 500 one-year total returns following bear market closing lows, a reminder of how the S&P performs when the Fed is cutting interest rates when the market's near an all-time high. We'll talk about NASDAQ 100 down years since 1995, how year 4 of bull market stats look going back into history, and Taylor's going to discuss new contribution limits for various account types looking out to the year of 2026. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Aaron, let's jump in.
Awesome. Happy to be back on the podcast.
As a kind reminder, Aaron, Senior Wealth Advisor, CFP,
Yep. Perfect.
here at the firm.
Perfect. You right if I do pricing?
Dig right in, man.
Awesome. I'm on it. So starting off with the S&P 500, it is up 17.1% year to date, up 1.1% month to date. The Dow Jones Industrial Average is up 12.9% year to date and up 1.78% month to date. Mm-hmm. The NASDAQ Composite Index up 22.5% year to date and up 1.62% month to date. The Russell 2000 IWM small caps is up 13.38% year to date and up 3.74% month to date. And lastly, the Vanguard FTSE All World X United States is up 29.4% year to date and up 1.83% month to date.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. Wouldn't it be crazy if the NASDAQ caught up to the international index?
Could. It's not
out of the realm of
possibilities. It's not out of the realm. What have we got? 15 trading days left, maybe, something like that?
Yeah.
It's doable.
It's possible.
I'm here for it.
I am here for that, too. The other thing that kind of is catching my eye, and I know you'll talk about it here in a second about the Fed, but the movement on small caps being so interest rate sensitive, let's call
definitely are interest rate sensitive.
So why don't you kind of share that news?
Yeah, last thing before I forget is where the Treasury sit at.
Well, perfect segue for you.
There you go. The 3-month Treasury is sitting at 3.67. 2-month Treasury is sitting at 3.52. 2-year Treasury, is at 3.52. 10-year Treasury at 4.12%. So yeah, leading right into big news and current events. Yep. Is the Federal Reserve lowered interest rates by 25 basis points or 0.25% yesterday.
Yep.
The target Fed funds rate sits at 3.5% to 3.75%, and the next FOMC meeting is in January on the 28th of 2026.
A couple thoughts there I want to throw out there that just came to me. One is I talked about on the podcast last week, which would be episode 329 if someone wants to go back to it, how the Fed's going to begin injecting liquidity into the system. This topic did come up yesterday, and they, in essence, confirmed to the tune of $40 billion a month they're going to start injecting into the system.
Yep.
And as a polite reminder, to give some cliff notes for individuals that didn't listen to the episode last week, since 2022, the Fed has taken out about $1.6 trillion of liquidity from the system. That is stopped recently, and now they're going to begin the process of being accommodated.
And they do that by buying or selling treasuries.
There
right?
it is. Yep. There it is.
So more open market stuff. So it's good.
Yes.
Stimulate the economy. Anything else on that? Or are you ready to jump into tweets, articles, and research?
Well, let's jump in.
Perfect.
Let's jump in. So my first piece I have this week is going to be from FS Insight. Okay. So this research firm had a good piece about top market days in any given year, how much, Aaron, they drive performance.
Interesting.
So Jenna will put up this illustration for our YouTube viewers. This will definitely be in our show notes. And this is what was written in the note on December 8th. Quote, only a handful of days drive the S&P 500's performance each year. Since 1928, the index has averaged an 8% annual gain. But if you miss the top 10 best days, that average, Aaron, drops to become a 13% loss.
Wow. That's 21% move.
Loss, right? In 2023 and in 2024, some of those best days occurred late in the year.
Santa Claus rally.
Oh, I love the good old Santa Claus rally. I'm going to start wearing the hat near the end of the year.
There you go.
Jenna's going to be getting some photos. So Fun Strats, Tom Lee. I like Tom Lee a lot. He kind of talked about this. So again, some pretty amazing stats when you look at it. Let's just talk about some of those top days. So in 2024, the top day was November 6th. The index was up 2.5%. You know, you miss out on that, and the next couple, you know, on it June 8th?
You miss out
August
on those
8th,
top
2.3.
4. That's 8% right there.
It's crazy. And this is just a kind of a nice, kind reminder for investors. It is extremely challenging to time the market on a shorter term basis.
What would Mark say?
It's
about time in the market, not timing the market,
yeah, I mean,
right?
It's just, it's crazy. So interesting stat. Next thing I had is from Charlie Bolello. This piece, Aaron, is S&P 500 index 1-year total returns following bear market closing lows.
Interesting.
Jenna will put up this illustration for our YouTube viewers. This will be in our show notes. This is what Charlie wrote. During bear markets, it's tempting to think you can get out and get back in when the coast is clear.
It's in quotes there. Yeah.
The only problem, by the time the coast is clear, many of the best days and the biggest gains will have already passed.
It flows perfectly in with your last piece, right?
It does, right? And saw that again this past year. When you look at earlier this year, from February to early April, technically on a closing basis, the S&P was not down 20%.
Very close, though.
But on an intraday basis, it was.
Right.
And there was a lot of people who got out in March and early April. And there's people out there, Aaron, that still
haven't gotten back in.
Still not back in.
Well, just jumping back to that last that last tweet you found from FundStrat.
Yeah, did you have the data for this year?
4/9/2025, April 9th was up 9.5%. So if you missed 2 days after the market bottom, you missed out on half the return for this year, right?
You're right. Yeah,
So
it's crazy to think of it that
painful.
way. My third piece, and you're going to see the narrative that I'm kind of going after here. Item number 3 is from Subu Trade. This has been getting the rotations online.
I've seen this. It's funny. I was going to use this same data.
Yeah.
Ryan Dietrich had the same exact data.
See, I like
But
that. That's okay.
You beat me to it.
Sometimes it gets heavy rotation, but I think for the right reason. So this piece is about how the market acts when the S&P 500 is within 1% of an all-time high and the Fed cuts interest rates. I've shown some data in the past in the podcast how the market acts when the S&P is within a 2% all-time high, and I showed that, Aaron, around the last rate cut in September.
Yep.
So on this piece, what you're going to see is that there's about a dozen and a half data points. That look about right by visual.
Yeah, it looks right.
So about on average, 1 year later, the average return for the S&P looking back in history is 15.08%. And this is the scary part with 100% positive rate. That kind of scares me, the contrarian in me. The 9-month number on average is 8%.
And still 93%.
Yeah. The 6-month number is very mixed for the record, 0.54 with a positivity rate of 57%.
Right.
But you look at it, 1 year out, proper time
pretty
horizon for
consistent data.
equities at least at the minimum.
Yeah.
Not a bad data set.
It is not a bad data set.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
AC, what do you got for listeners and viewers this week?
All right. First thing I have is a tweet from Ben Carlson.
Yep.
Always like his stuff and his blog.
He has great stuff, doesn't he?
Yeah, he has great stuff. His tweet says, the NASDAQ 100 has just 5 down years since 1995. Remarkably, every one of those years, the losses has been 30% or worse. I think this kind of fits, right with your theme earlier, right?
You picked this.
There's obviously not a lot of down years for the NASDAQ, but in some of those down years, it's pretty painful,
yes.
right? So what comes to mind with this is, you can't time those years, right?
They're
so
tough to time.
If you can, if everyone could get out before this happens and get back in at the perfect time, they would.
Sure.
But I think, the NASDAQ has given us some really, really, really strong returns over the last couple decades, but there's going to be some pain in those bad years because it is a more concentrated index.
Yep.
And tends to have higher beta tech names in it, right? So I think the last thing that comes to mind with this is just diversify, right? So that's why we buy different areas of the market. Maybe you have some international, some small caps,
Some value names.
Value names, not just technology, right? So obviously technology makes up more and more of our overall economy and indices, but again, there's still reason to have other areas of the market. The couple painful years from 2000, 2002, I think he's probably bringing up this data because of all the bubble talks, right?
Yeah.
So
I'll take it one step further because the data points of 2000 and 2001 stick out at me here. Because I've mentioned this on the podcast several times before, and I'll say it again. The current investment cycle within AI and data centers looks very similar to the run-up and spending cycle of the initial internet boom in the late 90s.
Yep.
And at some point within the next 2 to 5 years, you're going to have more capacity on these data centers built out where you could see a pullback in spending. And I think it could look and feel for the market similar to how 2000 to 2002 felt when tech spending pulled back a little bit after Y2K. You could have some similar movements at some point within the next 5 years. Yeah. But I would argue, I just don't think it is that imminent.
We're not there
some
yet.
Have been concerned about.
I think I would agree. I don't think we're quite there yet. As the spending continues to forecast, I know we've shared this on the podcast before, but the spending on those big four is forecast to be huge the next 2 years. Huge. Almost $1 trillion over the next 2 years.
Yeah. Huge.
So next piece I have for you is from our friend Ryan Dietrich here. It's titled Fourth Year Bull Market Expectations. So he says, we are in the 4th year of the bull market, which tends to be fairly strong. Given we see a likely economic acceleration next year, this should see history rhyme. So year 4 of the bull market tends to be strong, data back from the 1950s. So only one instance from the 1950s where year 4 was down. So it looks like, we're on pace to do that again. So it's pretty strong data there that I like. What are your thoughts?
My thoughts are, if you look at the lens of history going back to 1950 in the S&P, the average uptrend or bull market has a length of about 5 to 7 years. And we're about to enter the beginning of year 4. And when you just look at statistics, which this podcast is very stat heavy today.
We are stat heavy.
And we're blending perfectly right now. I think the probability of a positive year is justified. I think the biggest headwind for the market is that classic midterm election year headwind, right?
But couple that with don't fight the Fed, right? So
Hey,
some of that earlier
that
stats,
Wall Street adage is there for a reason.
It's hard to fight the Fed,
It's
right?
that way for a reason. You don't.
All right. Speaking of the Fed, I've got one more thing for you here. It's a tweet from Mohammed A.L. Iran.
I can reciprocate only because I've heard his name pronounced
Please help
so
me.
many times on Bloomberg. It's Muhammad Al-Arian.
Okay.
And that's
I got his first name
only
right.
reason I can nail that one. Usually you're the one helping me.
I know it's not my strong suit, but with proper names, it's difficult.
He's a big head honcho in the 90s and 2000s for PIMCO on the fixed income side. So it was him and a bond manager by the name of Bill Gross, who were really big. They were the two 800-pound gorillas in the fixed income space.
Interesting.
And then he's kind of transitioned more to an economist, kind of market strategist from being a bond portfolio manager.
That's interesting. Appreciate the background.
Yeah.
Okay, so he's got this X post here that says, per the @FT, an Atlanta Federal Reserve analysis of Bureau of Labor Statistics data shows that after years of above-trend growth, pay for America's lowest earners has slowed more sharply than for the highest. And this is as the U.S. labor market risks weakening further. So it's interesting. Obviously, from 2022 kind of through 2024, we saw a steep increase in wage growth, and that's because of inflation was elevated, right? So, companies have to retain employees.
That's right.
They have to raise wages.
It was a tight jobs market, really tight at that time.
Absolutely. So we've just seen that the lower earners have kind of reverted back to maybe more normal trends of wage growth, and the higher earners have stayed kind of elevated above that 4% wage growth per year. So, I mean, we could speculate on why that is. I don't know if it's trying to retain talent or if it's, I don't know. What are your thoughts?
My 2 cents is I do think there is more of an equilibrium in general in the labor market right now. I know that there are industries, Aaron, where that's not necessarily the case.
Sure.
But I'm going to make a generalization. I think the labor market's in a pretty good equilibrium.
Yeah.
So the degree of how the wage growth has come down along with inflation, that's a positive thing.
Agreed. And it's really, if you silo off 22 to 24, it's on a pretty normal trend right now.
Yes, and I think we're going to go back to this 3 to 3.5% inflationary range.
Yeah.
They might get CPI barely under 3, but expect 3 to 3.5. I think the wage growth normalizes to that 3 to 4%. That to me is not a bad thing, but it goes back to a couple years ago. In 2022, no one thought the Fed could thread the needle, bring inflation in without causing a deeper pullback, recession, fill in the blank.
Sure.
I don't know. I think you got
very interesting.
You got to give Powell some credit here.
Absolutely. No, I think he's done. Reluctant to say that, but I think he's done a good job.
I know. I know that he is not liked by the current administration.
No.
But my goodness. I mean, you look at what he's accomplished on paper, especially since 2022.
Very, very well done.
I don't know.
So interesting. Yeah, I don't know the reason for the divergence between the higher earners and the lower earners. Might just be. I don't know.
I'm going to speculate. Baby boomer demographics of retirement.
Could be.
I'm just throwing out maybe
the higher earners are in their
prime earning years.
Probably. I think that's a good assessment.
Something to do with it.
Awesome. Any last thoughts?
No, I mean, Aaron, you want to? I'll stay with Taylor's about to come on. Anything you want to share with podcast listeners or viewers before you head off for the day?
No. Other than Merry Christmas, Happy Holidays for everyone.
All right,
that's all I've got.
All right, well, we'll see you. We'll see you on the podcast here soon.
Awesome, thank you.
So next up to the podcast is going to be Taylor Ledbetter. She's a wealth planner here at the firm, handles all of our financial planning for the clients. Fan favorite. Taylor, welcome to the podcast. Taylor's also a CFP, Certified Financial Planner. And Taylor, what did you come up with for our listeners and viewers this week?
Yeah, so since we are really close to 2026, I thought it'd be a good time to review the new contribution limits for employer plans.
Okay.
Because if somebody is maxing out their employer plan, obviously you would want to make these adjustments come like January 1st.
Yep.
So this is going to apply to like 401k plans, 403b plans, 457 plans, basically any like defined contribution plans.
Got it.
So next year, the max employee contribution for these plans will be $24,500. That is a $1,000 increase from 2025. Catch-up contributions, which is for age 50 and up, is going to be $8,000, which is a $500 increase. There's also something called a super catch-up contribution, which is new in 2025, so not necessarily new in 26. But basically, if you are between the ages of 60 and 63, you can put in an extra $11,250.
Yes.
And then if you contribute to traditional or Roth IRAs, that limit for next year is going to be $7,500, which is a $500 increase. And the catch-up for IRAs will be $1,100, which is a $100 increase from
Interesting.
this year.
Interesting.
Yeah, I mean, these typically go up a little bit every single year.
Yeah.
But I know one brand new change starting next year in 2026 is that if your prior year wages from your employer exceeded $145,000, any catch-up contributions you do are going to have to be Roth.
I find that very interesting.
Yeah, I do too, because, you know, if you're above age 50, you're in those higher earning years. So it's a little different that they're going to require after tax.
They're going to be generating some
contributions.
upfront tax revenue on this.
So if your employer does not have a Roth option currently, you will not be able to do catch-up contributions next year. Again, if you're over that $145,000 for income.
Well, I think I have a lot of plan revisions, right? They're going to be adding that in.
Oh yeah. I'm sure they're going to have several plans. We'll have to make amendments because these changes, at least for the Roth side, will have to be in effect by December 31st next year.
Yep. Interesting.
And also, I wanted to review the income, just different income phase out limits for a couple different contribution types.
Okay.
So right now, if you are an active participant in a 401k plan,
Okay.
you can only make so much if you also contribute to a traditional IRA.
Okay. On the side, per se.
Yeah. So if you're a single filer and let's say you make more than $91,000 next year and you contribute to a 401k and you contribute to a traditional IRA, if your income is above that amount, you cannot deduct your traditional
IRA contribution.
Yes. So it's specific to if you are an active participant.
In a plan.
Correct.
Got it.
And if you are married filing joint, that phase out is $129,000 to $149,000. Again, you don't necessarily lose contribution rights, but you do lose deductibility rights.
Yes.
And then for Roth IRA contributions, this is regardless of if you contribute to an employer plan or not. But if you are a single filer next year and your income is between $153,000 and $168,000, that's where that phase out starts. So once you're over $168,000,
You're not eligible.
exactly. And for married filing joint, that phase out is $242,000 to $252,000.
Yes.
So if you are in that type of situation, then you would just do a backdoor Roth contribution.
Yes. And there is a piece on our website on tailored finance. I believe you have a blog post about that in the past.
I'm sure I do.
Yeah, I remember you had a piece on that. So you can go to jessupwealthmanagement.com. You can click on the Tailored Finance blog, and there is a search section. And if you're curious as to how the backdoor Roth works, I know Taylor has a piece on that.
Yeah.
Anything
Perfect.
else top of mind?
I don't think so.
I talked briefly last week about the Trump savings accounts that are coming out in the middle of next year. And I know that, based upon what I read, that they're not going to be accessible till early July. And I did preview to our listeners and viewers that at some point the next couple of months, as more information comes out, there's more certainty. I know you'll definitely have a blog piece at some point with the latest updates on it.
Yeah, because there's still some things up in the air.
Yeah.
It sounds like it's going to be kind of a mix between a traditional and a Roth, but things aren't set in stone.
Yes.
So,
And the other utilizations, the uses that you can get the money out without tax penalties. I know that's going to definitely need some guidance because that's a gray area right now.
yeah, it definitely seems like it's going to be more of a like retirement plan kickstart versus like an education plan kickstart, like a 529.
Well said. Well said. All right. Anything else before we sign off?
I don't think so.
All right. I do not either. So thank you, everyone, for listening to episode 330 of the Independent Advisors Podcast. We'll be back with you next week for episode 331.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.